Hey everybody, welcome back. Bill Drexler here. If I haven't met you yet, I'm a certified financial planner with Financial Cornerstone Group. And this video actually goes out to my father-in-law. We were having a conversation about the differences between Roth IRAs and traditional IRAs. Yeah, that's what we do on the weekends. And he had a bunch of really great questions. So it inspired me to do this video. It could be a 2-hour video, honestly. I've got to condense it a little bit for this medium. But let's go ahead and get started. I'm going to talk about what exactly a Roth IRA is, give a very brief history lesson, then discuss how it works, 2 ways that you can get money into a Roth IRA, and then we'll end it with some pros and cons of after-tax investing with Roth IRAs. So let's get started, and I hope this helps. So the Roth IRA actually originated as IRA Plus in 1989, and it was the brainchild of Senator William Roth and Senator Bob Packwood, Republicans from Delaware and Ohio, respectively. However, it wasn't until 1997, with the Taxpayer Relief Act, which was signed into law in '89, that the Roth IRA was introduced and was named after Senator William Roth. So what is it? The Roth IRA is a tax-advantaged vehicle that lets investors put after-tax dollars into an individual retirement account, or an IRA, for the purposes of tax-free income during their retirement years. The primary benefit of a Roth IRA is that your contributions and the earnings that you make on those contributions can grow tax-free and ultimately be withdrawn tax-free for qualified distributions. And those qualifying distributions are such things as reaching the age of 59 and a half, and provided that you've had a Roth IRA open for at least 5 years. So how do I get money into a Roth IRA? Well, there's 2 main ways. You can either make contributions, or you can do conversions. So you can either make ongoing or annual contributions from a bank account, write a check or whatever it is, to an IRA, or you can convert traditional IRA monies into a Roth. And it may sound confusing at first, but we're going to break it down and give you some examples. So let's start with contributions. So each investor can contribute from a bank account. They can write a check, however it is, up to $6,500 annually if you are under 50, and up to $7,500 if you're over 50, and that limit changed in 2023. Contributions can be made up to these amounts or 100% of earned income. So as with other IRAs, you or your spouse have to have earned incomes to be able to contribute. So secondly, investors can convert or make conversions of any amount of a traditional IRA. So you have traditional IRA money sitting out there. You feel like you're going to be in a lower tax bracket for the foreseeable future. You can go ahead and convert, pay the tax, move the money over to your Roth IRA, for example. And there's no limit to how much you can do. And for example, if you have an IRA with $1 million in it, you could technically convert that over to a Roth, although that would give you a really hefty tax bill in the year it was converted. Typically, folks will break it down over the next 3-4 years and just spread out that tax burden. But that is how a conversion is done. So what kind of assets can I hold in the Roth IRA? So typically, Roth IRAs hold securities, and they can be stocks, bonds, mutual funds, ETFs. But you can also have in CDs, money markets, REITs, real estate investment trusts, and other types of investments are eligible in certain cases. In self-directed Roth IRAs, you can even add derivatives, precious metals, art, and even real estate. Another pro is that contributions, the amount that you actually contributed after tax dollars, can be taken tax-free since you've already been taxed on those monies. Roth distributions are not used in the calculation of provisional income, which provisional income determines how much of our Social Security is subject to taxation. I did a whole other video on provisional income. I'll include that link if you'd like to include that as well, or review that as well. Next is it's a reduced tax rate risk. So there's multiple types of risk. I've done a whole video on that. And an additional type of risk is tax rate risk when it comes to investing and taking distributions. We don't necessarily know, and we can't pinpoint what taxes are going to be in the future. We can make educated guesses, but we can't say for sure this is the tax rate environment that we're going to be in. So we're paying rates that we know, and thus minimizing our tax rate risk exposure. Another pro for Roth IRAs is that they are not subject to required minimum distributions that traditional IRAs are, which, due to the increasing distribution requirements, the ratcheting up of the requirements set by the IRS, can create a compounding tax problem in retirement. Next, investors take in distributions from traditional IRAs, for example, for the RMDs. They may need to take out more money or withhold for the IRS to actually pay the tax. So the money that you're taking out to pay the tax, you have to pay the tax on. Moving along, Roth IRAs can be a wonderful estate planning tool, as monies passed to heirs from Roth IRAs are also tax-free as well. And as I mentioned before, traditional IRAs can be converted to Roth IRAs. And like we mentioned, this will increase the investor's tax bill for that year, as the amounts converted will be added to income. Now, if you're in a low environment, a low tax year, a client wishes to reposition to tax-free, this may make sense. But we always work in tandem with the client's CPA or tax professional to get a scope on the client's tax situation and the effect of the conversion. So we'll get projections to see what this will do to their tax situation for that year. So as with everything, it's not always sunshine and rainbows. There's potential cons to Roth IRAs. So as we mentioned, there's a limit to how much you can contribute. In 2023, folks under 50 can contribute $6,500, while investors over 50 can contribute $7,500 annually. Next is contributions. They're not tax deductible, whereas with traditional IRAs and within certain IRS income guidelines, your contributions can be tax deductible. So moving on, contributions are subject to eligible income limits. So if you make over a certain amount of money per year, in 2023, it's $153,000 for single filers and $228,000 for those married filing jointly. You're actually not eligible to make Roth contributions. You can still do conversions, but you can't do Roth contributions. And this also doesn't talk about backdoor Roth contributions, which is a subject probably for a whole nother video as well. And next is a potentially increased tax rate risk if you happen to be in a lower tax bracket in retirement than you were when you were working and contributing. It's somewhat unlikely from my experience, but it can and it does happen. So traditional IRAs have an immediate tax savings and benefit, as opposed to a future savings with a Roth. So regardless of the net total benefit, the savings with the Roth is delayed. And we all know with humans and delayed gratification, looking at a future benefit, sometimes folks want to take that immediate tax benefit. An investor may not live to realize that benefit. This ties into the last one. They may pass and move on to heaven before they actually retire. Although their heirs will still realize that benefit, though. And then finally, the penalty and tax assessed on non-qualified distributions. So let's say, for example, you're under 59.5, you take part of the earnings, there's a 10% penalty, and you will pay taxes on that money because you did not make qualified distributions. So the difference between qualified distributions and non-qualified distributions on contributions and conversions could be a subject for a whole nother video. And then finally, amounts converted from traditional IRAs can no longer be recharacterized back to traditional IRAs once it is converted. So it used to be that if you made a conversion and you realized you didn't necessarily want to do that, you can make a recharacterization. However, you can no longer do that. So that could be a potential con as well, which is why we always make projections on all the conversions that we're going to do with a tax professional, with a CPA on that particular client situation, just to make sure that we know the ramifications of doing such a thing. So in conclusion, really, all else equal, the math should come out the same. and this is what I was talking about with my father-in-law, Jim. Essentially, if you take the same investment amount, the same rate of return, the same tax rate, you're going to end up with the same net benefit. The math will all equal out. However, this is not always the case in the real world, and there's a lot of other ancillary benefits, such as not counting towards provisional income, things like that. And really, the main question is, where do you see your tax brackets in the future? A lot of folks look at our national debt, our fiscal challenges that we have, and they think that tax rates are going to need to significantly increase to cover federal expenses such as Medicare, Medicaid, Social Security, and servicing of our national debt. Just those four things are going to necessitate increasing our tax rate environment, which is a fair point. Lastly and finally, it's a good idea to have both. It's a good idea to have a good mixture of traditional and Roth monies to diversify your tax rate risk. And part of a good retirement income distribution plan is having options. It's having options year to year based on what tax bracket we see ourselves in. Are we going to have an event this year that's going to increase our tax rate? And plan it every year. If we have a higher income year, we take from the Roth. We have a lower income year, we take from the traditional. And we can even look at our RMDs and our standard deductions, try to offset that as well. So a lot goes into retirement distribution planning, other than just looking at the types of accounts, but also the tax types as well. So everybody's situation is different, and that's why having a trusted professional, financial planners, CPAs to act as guides is invaluable. And I know this is a very brief introduction into Roth IRAs. Like I said, we could have a 2-hour video on just Roth IRAs and everything about them. Maybe we will. But I hope that this helps in the meantime, and be good to yourself and be good to others. Have a good one.